Okay, so I've showed you the pin bar strategy, and now we're going to go into what we call the trend line strategy. So this is actually one of the most powerful strategies as well, and it is very simple to use, works on any time frames, works on any pair, involves no indicators at all, and allows you to enter high probability trades with high accuracy. So the entries are based on touch on trend lines that we're going to be drawing. The strategy is based on following the trend, so the odds is stacked on your side. So remember what we said, the trend is your friend. We trade with the trend, we don't trade against the trend. So we have the long entry buy setup and then the short entry setup here on the screen. Long just means we say we're going buy. So remember the jargon that I shared with you are some of the terms that we use. So when you say long entry, it doesn't mean that you're holding the trade for long, but it just means you're going up. And then when you say short entry, it just means you are selling. So this is a sell setup. So as you can see here, everything has been numbered. So for this is an uptrend. As we can see, it's an uptrend. When we draw our trend line here, touching all these points, you can see that we have our 1 and 2. We are waiting. So we use these points to actually draw our line. So point 1 and 2 is to draw your line. You don't enter. And you have to wait for the third touch. So the third touch is where you are entering the trade. So what happens is that, remember when we draw a trend line, you need to have at least 2 points that you can connect. So these are the 2 troughs that we were able to capture and use them to connect and draw our trend line. So from there, you can see that on the third one, you were able to capture this and you exit when it reaches the peak. So when it reaches the peak, which is the top, so the trend line above, when we hit that one, we exit and then we wait for another opportunity. We enter, we exit, wait for another one, we enter. And then if you see a breakout, you obviously hold your trade. But if you see that it's going to turn around again, when it creates another new peak, then obviously you exit. So the same thing for the for shorting the market when we're selling. So point 1 and 2, that is then put 2 points that we use to draw our trend line, and then we have to wait for point number 3 and 4, as you can see right there, which we can use to enter, and then here we exit at the previous lows. So the previous lows, because this is a downtrend market, so remember this was an uptrend, so we exit at the highs, so the new higher highs. Here we exiting at the new lower lows, so the lowest points when it reaches. So this actually, we have another trend line on top. You can actually draw another trend line on top so that you can see where the market is playing, which area is actually playing at. So remember, when you draw this trend line using these 2 points, they at the top also, they also have their peaks, right? So you can connect these peaks to see exactly where these points can actually come when you take a trade here, where you can potentially exit, right? Where you can potentially exit your trade. So that's why we use this sort of a channel, right? So we make it into a channel. That way you'll be able to see some potential exit points when you enter these trades. But basically, this is what you have to do. On the black dots, you wait, red you enter, and then blue you exit. So that's basically what is happening here. Very simple but very powerful strategy. So just to show you in a real market scenario right here, you can see that this is an uptrend that is happening in right here. So in this uptrend, we were able to plot our uptrend line. So as you can see, we took this trough number 1, trough number 2, and we connected them to both, and then we were able to capture the third point. This is where we enter. So you have to wait for the third point, the third touch on the trend line, for it to be valid, so that entry is validated. So you wait for the third point, and then if you miss the third point, you can wait for a putback. So never enter a trade after it actually like take off. So maybe you find this this point is already up here. The risk to reward ratio for you to enter the trade up there is much higher. So meaning that your risk is way higher than compared to your reward. So remember what we said: you never enter a trade where you risk more than you win. So you want to enter right at on the trend line itself and then capture that move. So this strategy actually helps us to capture a trend when it's just almost at the beginning stage, right? So right when it's just started. That's why we enter at the on the third touch instead of the fourth or the fifth. So we're aiming for that third touch, which is still in the development area, right? Still in the development stage, for us to capture that trend right at the beginning. So that's why we enter at the third point, which is like the validation of that trend line. So that's basically what you need to understand here. Just remember, first 2 points you don't enter, you use them to plot, and then the third touch you enter, the fourth you enter, and then you exit here where it makes new higher highs, and then when it's turning around. So remember, I said for you to be able to see the potential points where the market is going to enter, you can draw the upper trend line to see where the market can potentially turn around, right? So you can connect these other points looking at the upper trend line, which is a point where where the market has been respecting a lot. So as you can see here, there's an example. You can actually draw this trend line and connect these two troughs and then these peaks here. You can actually connect those, and then you can see that you can actually come up with a potential line where you can look for exiting opportunities to take profit, right, on these trades that you're entering here. So that's how you can use these two and build up a powerful strategy on its own. So as you can see right here, in a downtrend example, is the same thing. So here we actually had to wait quite a long time before we entered this trade, because look here what happened. We had our 2 points that we used to get our trend line, right, and then we got the trend line, but then we had these points which came a little bit closer to the entry point, but then it didn't touch the trend line, so we did not validate that. It was not a third touch, so we left that alone and we waited for it to actually come and touch. But as you can see right here, there's not much difference between entering here and entering right here. So basically you're still right at the beginning of this downtrend that was forming, and as you can see from here, it was a nice trade. It just went down. That's when the major move actually happened, and you know, the risk to reward ratio is much better, so meaning that your reward is much better compared to your risk, that how much amount that you're actually risking. Because if you enter a trade somewhere here, it's not valid. It's not valid because you don't have that third touch, so you have to wait for that third touch on the trend line, and then once it's bounced off, that's when you enter a trade. So as you can see, another opportunity to enter, and then there's exiting point. So remember, if you're in a downtrend, we use the upper one, the upper trend line, which is connecting our peaks. We use that for entries, and then you can also draw the second one connecting all the troughs in that downtrend, so that you can figure out some exiting points. That way it will make it easier for you. Otherwise, if you can zoom in quickly here on this chart, you will notice that right there where we're seeing exit, we actually have some candlestick patterns that you can take a look at and see that, okay, cool, the market is actually about to turn around. For example, right here, this last one here, you can see that we actually have a pin bar and a doji right here. So that'll be a sign for you to actually exit that market after capturing this whole trend right here. So, but at the same time, I don't know if you can actually notice here as well, we have another bearish pin bar showing us that the market is actually about to turn around and go down, and is at our trend line. So we don't use one strategy on its own. We have to incorporate all of them so that we can get a perfect trade and more powerful signal, right? So here, as you can see, we touch the trend line. At the same time, we have a bearish pin bar. We enter the trade. We came here, and then we were touching a point which is connected to our previous lower lows. And at the same time, we saw that we had a pin bar. It rejected, and then there was an opportunity to exit. Remember, we trade with a trend, so we don't want to take this trend going up, because it's not guaranteed that it will actually go up all the way back here. It might just, you know, play around and then continue down. So that's why we trade with the trend, not really against the trend. So when you enter this trade, you actually capture more pips than when you enter this trade going back to the trend line. So it's more important to capture the trades that touch our trend line going in the direction of the trend, right? So in a downtrend, we're looking for selling opportunities. In an uptrend, we're looking for buying opportunities. So that's just basically what is happening. So uptrend is going up, we are looking for buying opportunities at the lines, at the trend line that is below, that is connecting the troughs. And then in the downtrend like this, we're looking for selling opportunities at the point with the trend line that is connecting the peaks. So that's what you need to know and understand. So if you get that right, you have mastered what you need to know about the trend line strategy.